The decision to take on debt in retirement is a little bit like the decision of which roller coaster to choose to ride. When we're young, oftentimes we want to choose that roller coaster that is going to go as fast as possible because that meets our goal of having a lot of fun and building this sense of joy. But as we get older, as we get to my age, we don't want to ride those fast roller coasters nearly as much because it disorients us. In the same way, over seasons of life, sometimes our priorities and our goals shift in such a way that that doesn't make as much sense in retirement as it may have in other years. And we want to talk about that today.
So Spencer, today we're going to talk about debt and retirement. And the reality is there's some complex times that life throws at you that debt is almost a necessity. When you're young and you don't have any money and you want to buy a house, you have to take on debt. It's not always the same in retirement. And so let's talk about some of the reasons why clients might consider taking on debt in retirement. What are some of those factors that they want to consider?
Well, and we get this question a lot from a lot of different angles. Should I take on debt? And it's from different types of people. We have people who are very affluent who could make those purchases out with cash in hand who ask that question. We have people who ask that question because they want to buy an aspirational home or vehicle or what have you, and they're wondering if maybe they should take on debt. So it comes from a lot of different angles as we think about it. And it's because we don't have the funds in hand that we need in the particular tax location sometimes too. So there's a complex set of things that we need to really think through, but we always have to come back to that question of why? Why are we taking on debt, and what are the real trade-offs that we face? So as we think about it, what would be some reasons to consider taking on debt? Well, the first one is that it's a temporary need. So if we have a situation, and we see this a lot, where a client is moving from one home to another, they might be downsizing their home, but they don't want to sell their existing home before, or close on it at least, before they move into the new home. We've got at least a few days and sometimes a few months and maybe even a longer period of time where they're not going to have the funds to own two homes as easily. So what one solution can be is a bridge loan for those real estate transactions. And banks have different ways that they call this and how they structure these types of notes, but they end up being rather short-term instruments, oftentimes that are based on the collateral of one or both homes. And the interest rate oftentimes is a little bit higher than, say, a 30-year mortgage. But oftentimes the underwriting process is not quite as difficult to walk through because, again, this is just a bridge loan. This is a short-term loan that they might be looking at. So, again, we kind of come back to that first thing. If there is a short-term need for funds because maybe they don't want to take out extra funds from an IRA and trigger tax to be paid on that, or maybe they don't want to harvest long-term capital gains and trigger those long-term capital gains. Instead, they would rather have a step up in cost basis, maybe 10, 15, 20 years down the road when they pass away so they can pass on more to their loved ones.
Yeah. So the second one is kind of similar in this short-term transaction. So it's a HELOC. Walk us through why someone would want to consider a HELOC.
Again, short-term, you have a home equity line of credit or a HELOC, and this can help to balance out differences in income versus spending. So let's just say you have a really bad month and you have an HVAC unit that goes out and you have significant repairs to your vehicle. And instead of being able to tap fully into that primary reserve, which is usually 3 to 6 months of living expenses, let's just say you blow through that and you still want to have a little bit of resource there, but you blow through that for the most part, you might need to be able to tap some extra funds there. And a home equity line of credit is set up where you're only paying interest for the time that you take out those resources. So this is something that I've had in place for many, many years. But in the event that we have a month where we need a little bit extra to be able to balance out some things, like we did a renovation on our home, we put in a fence, we did a bunch of different stuff. So it was very helpful to be able to use a home equity line of credit for a short period of time until we could pay it off in a few months. So that home equity line of credit, again, it doesn't usually have the same underwriting standards that, say, a 30-year mortgage or something like that might have, because you're using the equity in your home, which for many people is quite substantial, and the amount that you're borrowing against that is fairly small. Again, for most people, if you're just using it as a way that you can tap into some funds on a short-term basis and then pay it right off. What you don't want to do, if at all possible, is keep that note in place for a really long time with a lot of funds against it, because again, the interest rate tends to be a little bit higher than what we typically find for, say, a 30-year mortgage there. Yeah. So keep that in mind.
Okay. What are some of the other reasons that we would want to consider maybe taking on some extra debt in retirement?
Well, let's just say that we have a really bad tax year and that we have a lot of income in a particular year, but that income is already earmarked and we've got enough resources we can see to be able to use over the course of a long period of time. But we don't want to trigger bad tax situations in that particular year. While we might take out we might use a HELOC, or we might have a shorter term loan there that we would use without liquidating resources. Again, if we were having to pay, for instance, in a year 35 or 37 or 39% ordinary income tax plus state income tax, in some states, that can be a pretty punitive withdrawal. But let's just say in that same year, we've had it that we want to have a big birthday celebration or marital celebration or take the family on vacation. And we know that we've got the assets to do that long term. That's built into the financial plan. We just don't want a bad tax situation or some other circumstance to present itself. And so again, we use some kind of financing vehicle just on a shorter term basis there. And this would be maintaining that lifestyle. It wouldn't even necessarily be, I need to replace an HVAC or I need to get a new vehicle or something like that.
Right. Okay, so we've talked about some reasons why it might be an okay reason to take on some debt. What are maybe some of those yellow flag reasons where we would say, hold on, this is maybe not a best decision?
Right. So anytime we hear a client start to say, well, I think I might take on some debt so I can invest more. Usually the debt that we take out, whether it be a home equity line of credit or whether it be some kind of interest rate on a margin type of account that they might have in an investment account, usually those rates are going to be quite high. So the bar there, if you're paying 9% or 8% on a home equity line of credit, you have to get a really nice rate of return to be able to get above and beyond that. So we know that the interest rate being that high, there's a certainty that we've got that expense. So we really need to have a very, very high level of certainty that we're going to get something better there. And that is something that is very rare, to us to see. Another reason is that we don't want to take out debt to fund a lifestyle that we just cannot afford. And this may sound a little bit different than one of those former reasons, but really it all comes back to the financial plan. If we have circumstances where we're taking on debt or we're just not paying down debt, maybe we're keeping that home equity line of credit fairly high and we're using the funds that we could have used to pay that down to take a trip to Europe or Africa or some other place that's very expensive. We really have to look in the mirror and say, good gosh, am I just funding my lifestyle with this debt? Do I have what I need long term to be able to make the payments and live with wisdom here? Because the more that we pay on our debt, that's the less that we're going to have in resources to be able to utilize, not just now but in the future there. So it always presents against us any debt that we take on. Sometimes, as we talked about at the outset, that makes total sense because we're paying on a 30-year mortgage. We have our home. We're able to enjoy that. We're able to pay a fairly low interest rate potentially on that relative to renting. But anytime that we're just funding lifestyle based on and using debt to do that, that's going to create challenges down the road.
Yeah. Well, we've even heard stories from people that said that they were being generous, but taking on debt so they could be extra generous in their giving. Mm-hmm. That's a really bad situation that you're getting in to leverage your lifestyle so that you can even do something philanthropic. Mm-hmm. So again, there's reasons why debt can make sense. There's reasons why maybe just psychologically we've kind of done some hurdles to make it make sense, but it really doesn't make sense. So Spencer, we've talked about some cautionary tales about the types of debt to take on. what's maybe some of that psychological impact of taking on debt, especially right before we enter retirement?
I think we need to recognize that psychologically, when we take on debt, there is a level of risk. There is even an element that impacts us physiologically, biologically. Any survey that you look at among retirees will show that folks that have a higher bank account, just a higher raw level of resources in their bank account, sleep better at night. They feel more rest. And the same can be said for the amount of debt that they have. People who are debt-free have less psychological stress because if their income drops a little bit, their investments drop a little bit, they have their home paid outright. They don't have debt against that. They don't have credit card debt that's significant, that's accruing at something like 2% per month, that they're always trying to get out from underneath, such that if things don't go quite right, investments or their consulting job or whatever it might be, then they're in trouble. Mm-hmm. So I often will tell clients who say, well, I've got a 3% mortgage and I could make, a money market investment and maybe get 3% from it. It seems like it's even to me. What should I do? And I always pose the question back to them, well, what would you like to do in this? And if there's even an inkling that they'd like to pay off their home, even though it seems like a fair trade there, then the encouragement is almost always to pay off the home. I've never been in a circumstance in practicing where a client paid off their mortgage and wished that they had not done so.
Yeah.
I've seen literally hundreds of people walk through that scenario where they've paid off the mortgage. Oftentimes they'll pay off a mortgage, a few years before retirement, right at retirement, right after retirement, maybe 10 years before retirement. It happens at different times for every couple and every individual that we work with. But when they pay that off, there is a psychological impact to that is positive. And that goes far beyond what we would see in just the net worth statement or the cash flow statement or any of these different things. If they're paying $2,000 a month on a mortgage and they know that they have that obligation against them, once that's done, there's a level of freedom that they experience there, even if we've already factored that into their financial plan. So we don't want to take that too lightly because it is a real impact of confidence and rest that clients feel in their lives. So to take on debt, we feel like we've got to have a really substantial reason above and beyond that. Not just, this could be one way or this could be another way, but there needs to be really a tangible reason of why we need to do that. And again, to my thinking, a bridge loan, a HELOC, those short-term pieces can sometimes make a good deal of sense. Right. Beyond that, I think it's more rare that we find a client that is willing to embrace an increased speed of the roller coaster, for reasons that may not pass the test.
Yeah. Well, and even just anecdotally, as I think about paying our mortgage, I would know exactly when paychecks were going to come in. I knew exactly when the mortgage was going to come out. But there would always be some months where I would get really anxious right before it came out, or it's the first of the month and I'm frantically making sure, logging onto my bank, just checking, making sure, okay, yeah, I got paid, the money's in there. And so if you pay off that mortgage, if you don't have that debt that's looming over you, then you don't have to have that knee-jerk reaction of, oh my gosh, it's the night before the mortgage is coming out. Do I have the money in the checking account? There's just a freedom and an ability to just slow down and be thankful that you don't have that looming over your head. Right. It's a really nice piece of freedom. So we would say this kind of across the board, not just in retirement, but one thing to avoid debt-wise in any season of life is high interest credit card debt.
Oh goodness, yes.
So if you're thinking about not paying a credit card bill because you just may not have exactly the right amount, those loans can be 25% or more. And so we would just say, if you have the means to pay off credit cards, absolutely do so as fast as possible. That is a major red flag that we just want to say, avoid high interest credit card debt, bar none.
Right. Well, and the same could be said for any other kind of arrangement that is set up, whether that's between you and another person or institution. Those double-digit interest rates are things that can absolutely sap your financial future. You want to avoid those almost at all costs, and get in a place where you can look at cash flow and be able to deal with life with that cash flow. One of the things sometimes that we'll see, and sometimes clients will come to us on, is they'll have somebody leaning on them that's a family member or a friend leaning on them for some help. And if there is ever a time when they would need to go into debt to be able to provide some of that help, we're going to push back significantly, because taking on debt to help somebody else is almost always a bad idea. We've got to personally get to a place where we're comfortable looking at cash flow, income, outgo. But then even the people that we love, we've got to hold their feet to the fire if they're coming to us and asking for that level of help, to say, no, I'm not going to do this, particularly if it puts me in a situation where I might need to take on any debt.
Yeah. So Spencer, one last thing before we close out here. What would you say if we had a client come to you and say, should I take out a 30-year mortgage just before retirement?
Mm-hmm. It's an important question, and there's not an easy answer, yes or no, there. But we do have to grapple with the trade-offs. So one side would say, if you're taking on debt and it's for the next 30 years, and you may be paying on that into your 90s, do you want to have that payment that's going to go out so long? We would come back and oftentimes we'd say, well, is there any way that we can shorten it to a 10-year term or a 15-year term there, or maybe not buy so much house that you could afford just a 10-year or 15-year term? Just simply because that's a long time period to commit oneself to. And if you're not working and don't have that consistent income and you're just relying on investments, then on some level, we're just levering up our portfolio, because we might have, let's just say your net worth is $2 million, but now you're deciding to take on $1 million worth of debt to have another $1 million in a home. So your net worth didn't change, but now we've levered up where we've got $3 million of assets against $1 million of spending. Obviously, that's a big, nice home, probably $1 million there if you're entering in, right at retirement. But you're going to be paying on that 30 years. Mm-hmm. That's a long time. Yeah. So some of it depends on, obviously, the amount of the debt relative to one's net worth. But generally speaking, we find that clients have, again, a great deal of rest if they can be debt-free either at retirement, prior to retirement, or soon after retirement. Getting too far into retirement, still having that obligation. If the stock market on average has dropped substantially every 5, 6, 7 years, if you get into retirement and you haven't paid that off, at some point in time in the very near future, you're going to have a big market drop, and at the same time, you're still going to have your debt obligation, and that's not necessarily a fun spot to be in. So being able to pay that off just gives a lot of financial freedom, but in some cases, again, it's well within the plan. It might be better than renting if that was the alternative. And so we have to say, okay, well, whether it's a 10-year, 15, 20, 30-year mortgage, that could be, the best path. But we need to really look hard at the trade-offs there and make sure that we're grappling with how much home we actually need there, and if there might be better options that would reduce just the overall stress level. Because again, you take on too much debt in retirement, and it's going to feel like that roller coaster that's moving really quickly. That again, if you're 25 and you've got 40 years of work ahead of you and earnings, then you're going to pay that off, Lord willing, in 10 years prior to retirement. That's not the case as we get into those years that are close to retirement or in retirement.
Well, Spencer, thanks so much for walking us through some of these examples of where debt may make sense and where it definitely does not make sense. Clients, if you have questions, feel free to reach out to us, and we will see you next time. If you like these financial planning videos, please share it with a friend, and if you have questions, go to our website at SeriousRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SeriousRetirement.com. The information in this recording is intended for general educational and informational purposes only, and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.